Coming hot off the heels of a week that's been dominated once again by Donald Trump and the left field tariff announcements that have been occurring over the course of the week just gone. The new week has plenty to sink our teeth into when it comes to the economic calendar, most notably the US inflation rate, with the Federal Reserve saying that they think inflation is going to rise over the coming months, and certainly Donald Trump not thinking that. Who's right? We also see UK inflation and a raft of Chinese data coming out, so plenty for us to sink our teeth into for the week ahead. As ever, let's take a look at the forthcoming top tier items. And as you can see, we kick off the week with a focus on China, with the trade data coming out, notably imports moving sharply lower, exports moving sharply higher for the month of May. So how do we look for the forthcoming month? Well, markets expecting improvements there. That theme for China continues into Tuesday. GDP data, industrial production, retail sales, all coming out in the early morning, and then we focus on the inflation figures. You can see here ZEW economic sentiment out of Germany, yes, but then we've got Canadian inflation, US inflation, then on Wednesday UK inflation, US PPI, and then back end of the week we're talking about the UK jobs report, Japanese inflation rate, University of Michigan inflation expectations will be a key part of that. So a big focus on inflation, most notably over the course of the coming week. And the big number really is going to be the US CPI figure and core CPI figures. Now, as we can see here, by and large, the expectation is that inflation is going to remain under control for the time being. You can see that the core and headline monthly figures for last time around were 0.1. Now, that's exactly what the likes of Donald Trump will have been hoping for, and he wants to see something similar. The longer that he can show that inflation is under control, the more justification we have for the Federal Reserve to start cutting rates. However, the fact of the matter is that Donald Trump has been on a daily basis pretty much coming out with new tariffs, taking aim at everyone that he deems necessary, whether it comes down to trade, whether it comes down to sectors or products in particular. For example, 200% on pharmaceuticals products, 50% on copper. Then we have, of course, all of those sort of reciprocal tariffs, the likes of Japan, the likes of Korea with 25%, a whole raft of them. Then we see a 50% on Brazil coming out because of a court case against the ex-president. And that really was a warning sign in my mind that Donald Trump is going to utilize tariffs over the course of his tenure. There had been a feeling that, yes, you're going to see some near-term bumps, but once it's all resolved, the whole tariff thing's going to go out the window. People are going to forget about that, and the US economy is going to boom, etc. Well, ultimately, if he's trying to utilize tariffs for his political gains, whether it comes down to his own political gains or, on this occasion, trying to help a friend in need with a court case going underway in Brazil against the ex-president Bolsonaro, well, that is a concerning predicament to be in, really, because what's going to happen to see that tariff removed. So that is a big concern. Now, certainly, if we're looking at the risk for higher inflation in the US, you've got, of course, the numbers as they are at the moment, and that is under control, set against the backdrop of the expectation of higher inflation. And that has come from the Federal Reserve itself. Jay Powell has been quite explicit that he expects to see inflation rising over the coming months. Now, bear in mind, we're at a stage where that deadline keeps getting pushed. So the big tariff numbers come into play on the 9th of July. No, they don't. They come into play at the 1st of August. Will he push that deadline once again? That remains to be seen. However, what's notable is many of these big tariff levels haven't actually been implemented anymore. So to say that tariffs don't cause inflation would be somewhat disingenuous if you also plan to raise tariffs across a whole raft of nations, and that hasn't come into play yet. So there is still a strong possibility that inflationary pressures do start to build, whether it comes down to the measures he's implemented thus far, or whether they would build off the back of new measures coming into play, potentially on the 1st of August. So ultimately, in my mind, you have it one of two ways. Either this inflation report proves that inflation remains under control, or we see inflation start to rear its head once again. Now, think of it this way. If we see inflation coming in high, then markets are going to be very fearful or respond that this is the beginning of a resurgence in terms of inflation pressures. If we see inflation remaining low, yes, this will embolden markets and market participants for the time being. But I think it's relatively short-lived because the perception of potential inflation down the line still remains, right? So, you can discount that near-term reaction by saying, well, we always thought it might take a few months to filter through, and therefore maybe it happens next month. Or maybe next month we see those reciprocal tariffs coming into play, and that's where the inflation pressures start to build. So it's quite easy to discount low inflation figures. It's quite easy to get carried away with high inflation figures. And that's where you see the skew in terms of the potential volatility coming around this release and the likes of the core PCE price index down the line. In terms of the charts I wanted to show you, I'm going to provide a wider, sort of bigger CPI breakdown video for you. But for this one, I wanted to just show you this. This is a breakdown for the monthly CPI numbers, CPI, core CPI, and the core PCE. And what this does is it gives you a good idea of exactly how price pressures have been over the near term. We get often carried away with looking at that year-on-year figure and saying inflation's at 2% or 2.5 or 3%. And where is it relative to the target? Because that, of course, enables the central bank to then take action or not. But a lot of the time, you get so caught up in that big number that you don't really track exactly where the trends are over the near term. And that comes with the monthly figures. And so we can see here that March figure, very low inflation in March. We then saw April, we saw a pop, but generally, around between that 0.1 and 0.2, that's exactly where we want to be, right? That takes you back towards that 2% target. What we don't want is 0.4s and things like that, right? So that's problematic. And so over the past few months, inflation has been by and large under control, and we have seen it cooling. But of course, businesses within the US have had a lot of uncertainty. Consumers and workers within the US have had a lot of uncertainty. So it makes sense that things aren't necessarily overheating in terms of the economy. You also have the influence of low energy prices. The downward pressure on oil prices means people are paying less at the pump, businesses are paying less in terms of cost. So, all of these things are providing a sort of, or putting a lid on prices for the near term. But there is a fear that we could soon enough see these prices passed on to the consumers with regards to the tariffs. Now, the chart I wanted to show you guys was gold, right? So gold is by and large a metal that outperforms at times where you can say it's a haven, but it also outperforms, certainly within this environment, at a time when we're expecting to see more rate cuts. Certainly it's undermining the value of the US dollar, and it's pointing towards, further easing down the line means people generally move away from sort of fiat assets, moving more towards the likes of gold. Now, what would it take for those expectations to change? There is a view that we could see, a weakening economy. There's a view that we could see weaker or higher inflation. And the way that it comes in terms of what impacts the outlook for interest rates, whether it comes through inflation or whether it comes through weaker economic data, they kind of play two separate roles. So let's look at it with relation to this inflation gauge. So we have this green line, which is inverted, but essentially it's the rate expectations of where rates will be by year end under the Federal Reserve. And so I've inverted it because it tallies up well with the price of gold. And I think that inverting the gold price isn't necessarily ideal because gold is the thing that you're trading rather than rate expectations. And so by inverting it, I'm saying, okay, if this line goes higher, it means markets are expecting more rate cuts. If it goes lower, the green line, then they're expecting less rate cuts. And in actual fact, we did see a bit of a pop recently in terms of the move higher. A lot of it came around the weaker inflation figures coming out of the US. And so that highlights the fact that we could see an expectation of further rate cuts coming into play if inflation continues to be under control. But notably, we haven't necessarily seen too much of a dramatic move coming into play for the likes of gold around that move. Now, Notably, gold didn't pull back when we saw markets expecting less rate cuts, but it also didn't react too much when we started to see a call for more rate cuts. And arguably, because of the haven role of gold, it would potentially react more so if we saw a real sharp deterioration in terms of the US economy, because you have that haven role coming into play alongside the need for higher degree of rate cuts come into play. Nonetheless, if we see inflation leading to a picture where we're going to see a greater confidence of rate cuts, then that's potentially supportive for gold. But like I said, if we're talking about the potential for volatility to come into play around this announcement, I think it comes from the opposite side of the coin. And that is that if we saw very strong inflation data coming out, that's likely to spook markets. That's likely to ease calls for rate cuts from the Federal Reserve. And that would potentially drive near-term weakness for gold prices. Now, from a long-term view, I am very constructive gold. I have been long gold for a long time now and have come into this whole period thinking gold is a very clear-cut market to be following for a number of reasons. I think that ultimately, when you see rate hikes to the degree that we did, rate cuts were always going to follow, and rate cuts generally do benefit gold. But of course, when it comes to the Federal Reserve, those rate cuts haven't been super forthcoming, and now Donald Trump is doing his best to try to raise inflation once again. Maybe he doesn't. He is doing his best to keep a lid on it down to energy prices. Anyway, so let's look at the chart for gold, and we'll see exactly how things are shaping up. Like I've said, we've seen some volatility coming into play recently, but by and large, you can see on a weekly time frame that we've been sort of stalling here at the moment. And so there is a good chance that if we see very strong inflation data coming out and a resurgence in terms of inflation pressures, then you see the potential for a breakdown coming into play here for gold. At the moment, the question mark here is, are we seeing this sort of rolling over? Because you can see here, higher highs turning into lower lows, or are we going to be basing out once again? You can say that we've broken up through this swing high. We're now pulling back into a retracement phase before the bulls come back into play once again. It's coming to a deep fib zone between the 61.8 and 76.4 fib. Well, look, I think the key thing here is just follow things on an intraday basis. I think there is a good chance on either direction. I'm positive for gold over the wider context, but if we do see strong inflation data coming out, then I wouldn't be surprised to see some near-term downside and the continuation of the sort of rolling over we've seen over the past couple of weeks. So look out for this. As long as it remains below 33.45, there is a risk associated with this inflation report that if it comes in strong, we could see this rolling over once again. Then next up, let's talk about the UK region. So we have a move into UK assets over the course of the past week, alongside many other European assets. In part, this comes down to the fact that people are becoming quite fearful of the US. There's so much uncertainty in the US that people are sort of moving towards areas of greater certainty. We also saw that bump in terms of copper prices after the copper tariffs were announced, and that benefits stocks within the FTSE 100 because of the fact that we have a number of mining companies, the likes of Rio Tinto, Anglo American in there, benefiting from that move. Now, we have inflation coming out this time around, and as we can see here, there's an expectation it bumps higher once again, 3.4 up to 3.7, 3.5 up to 3.6, and on a monthly figure, 0.4 and then 0.3. This is the kind of thing that could really undermine calls for a rate cut over the near term from the Bank of England. Now, in terms of the charts, we can see here that the problematic figure really was for April, where many of the different policies under the new Labour government came into play alongside their energy cap moving higher. And all of it provided this sharp bump in terms of prices. It's going to be difficult to strip that out unless we wait for a year, essentially, with over 1% for both headline and core. So it's going to be a while until we get back down to target. And certainly the question mark here is, do we see inflation data providing a cause for concern? And then there is a strong possibility of that. We can see markets by and large expecting to see higher headline and core and higher monthly figures across both. That is problematic. Nonetheless, if we're looking at sort of sentiment for the near term for the likes of the FTSE 100, we can see here that we've managed to pop up into record high territory. There we go. So The trend at the moment is certainly on the side of the bulls. But nonetheless, I do think at some point we're going to come into a retracement phase, and perhaps this inflation report could do exactly that. I think, this could be the thing that essentially dampens calls for a rate cut over the near term if we do continue to see inflation rearing its head once again. So if we see a near-term pullback, then essentially it doesn't necessarily mean that the trend is over. I would just deem it to be a retracement of that rally from 86.94. I can't necessarily draw on a fib retracement, given that I don't necessarily know where it would top out. But if we do see weakness, let's say it's here, if we do see weakness, I wouldn't necessarily be put off this market too much. If we break the 86.94, that's when it looks like a wider pullback's coming to play. Until then, the bullish trend is in play, and a pullback, in my mind, would be deemed a likely retracement short-term move before the bulls come back into play for the FTSE 100. And then finally, we have the Chinese region. Now, China, we have a raft of data points coming out over the course of the week. We've got trade data coming out on Monday. We've got house price, GDP, industrial production, retail sales, fixed asset investment, you name it, on Tuesday. And so where are we expecting these things to move? Well, we're expecting higher exports, higher imports, GDP expected at 4.1%, industrial production expected a bit weaker, retail sales weaker, fixed asset investment higher. So really a mixed bag, higher unemployment as well. So definitely a mixed bag to go at. You can see here in terms of sort of GDP levels, we are below the pre-pandemic levels when it comes to quarterly GDP and annually as well. But by and large, I would say that this sort of roadmap that I've brought up many times in the past, notably with dollar yuan, but also for the US dollar itself, is notable. You can see that over the course of the first, say, 300 days under Donald Trump in his first tenure, we saw significant downside for the US dollar against the Chinese yuan. That benefits the US from a trade perspective. So there's definitely benefits for the US to do exactly what it's doing. And really, this is driven, in my mind, primarily by this move out of US assets, move away from the theory or the idea that essentially everything focuses around the US. That's not necessarily the case when it comes to the FX markets at the moment, and people are certainly favoring many other currencies over the US dollar. It's been suffering, but this does benefit the US from a trade term perspective. It puts them in a good position. So you add that alongside tariffs, and really they're both doing the same job. So if we look at this blueprint and we look at the trend that's been playing out since Trump came back into the White House, I wouldn't be surprised to see further downside coming into play for the US dollar against the yuan. So if we look here in terms of, let's just get the US dollar against the yuan up. So this is the chart on the daily time frame. And you can see from a wider perspective, we're sort of within this sort of wider chop. By and large, in the past, the lows have been sort of 7.1, 6.97 kind of area. They're sort of below where we are at the moment. So that does point towards a possibility of further downside sort of area to run into. If we look in here in terms of the 4-hour chart, you can see that this lower highs, lower lows turns into higher highs, higher lows. But I see this as a retracement of that move, right? So you have the potential for this to be a sort of, let's see, try and cap some of the tops. Yeah, it's difficult, I mean, look, you could be drawing your trend lines all the way up here. That's something. You could be drawing it utilizing near-term sort of levels, and you'd be watching out for that. But, I don't necessarily think any of them are particularly perfect. They're not tallying up perfectly, but the trend is pretty well defined. So if we look at that sell-off and then rolling over and then pull back, you wanted to use that as the sort of major swing high of that move. We then pull back, and then so what we're looking at, well, it's absolutely perfectly pretty much coming to the 76.4 fib and now started to roll over. But the near-term trend is bullish. Higher highs, higher lows, comes into the fib, pulls back. So to me, if we break below this swing low that we have down here, which is at 7.169, that's when the bears look like they're back in charge. A break up through this 7.2 swing high essentially negates that view and points towards the bulls coming back into play once again. But we do have a clear downtrend that has been playing out over recent months. And despite the rally that we've seen, I wouldn't be surprised to see the bears coming back into play before too long for the US dollar against the Chinese yuan. I hope that's been useful. Make sure to like, subscribe, and follow for more content like this. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and have a great week ahead.